said something super, I mean, it's interesting that you said that's a changing way to look at underwriting and of trends. I have a book right now, the link of like banking and lending throughout like the last 150 years. And I'm interested in reading it because there is changes that happen. In the residential loan market, you know, you had these no income, no verification loans. Have commercial loans changed a lot, and have they become more restrictive or less restrictive? Is there more creative approaches to underwriting?
Yeah, it's definitely been it's gotten more creative, and when it gets ahead of itself, it starts seizing up. The residential loans and residential lending is reflective of this country's policies.
Okay.
And when you buy a house or a condominium, you are able to write off the interest. The reason is because the country wants to encourage people to buy houses. It makes them more stable.
Right.
Somebody who owns a house and lives there for their entire lives and then retires is less of a burden for the country than someone who doesn't have that house and is a renter.
Okay, yeah.
Because they sell their house.
Yeah.
They've got their nest egg. Even if they weren't smart enough to save, they still have that house.
Right.
And so as a country, our policy has always been to encourage home ownership.
Right.
And so going back to your question about this no income verification, that was something that Fannie and Freddie went up. Those are the buyers of these home loans from companies that originate them. They were buying those loans.
Right.
And so what that did is that just opened up the market to bad credit.
Right.
And what they did is, if you remember the analogy I used before about securitized loans, which are going into a trash compactor, they come out, and then the rating agency looks at all the assets in the trash compactor and goes, okay, 80% of those we're going to rate AAA.
Right.
The tragic and I don't know what other way to put it, fraudulent methodology of evaluating single-family loans was completely uncovered and resulted in the crash of 07 and 08. Go back and look at our analogy. We take all of these loans which are from people who don't qualify. They're 95% financing. They are all very, very weak, very, very weak credit.
Right.
It's going in the trash compactor. Millions of them.
Yeah.
We now have half a billion worth of loans. Okay, take them out of the trash compactor, take them over to the rating agencies, and the rating agencies, up until 2007, happily went, okie dokie, first 80% we're going to treat as AAAs.
Wow, okay. And they weren't.
It was crap.
Yeah.
It was people who couldn't qualify. It's not as if they put in a cross-section of everybody and then a very small section.
Yeah.
They would put specific pools of loans which were junky loans.
Right.
And get them rated by the rating agencies who were complicit. And they all defaulted.
Right. Yeah.
Somebody who buys a $500,000 house because they've got a 2% rate, which has moved up to market to, let's say at the time it was 6%, is going to default as soon as it moves up to 6%. Because they can't afford it. They can afford 2%, they can't afford 6%.
Right.
The market was at 6%. These
Yeah.
people can't afford it. And so the brokers would get the people in the house telling them home prices or home values are going up 10% a year.
Yeah.
So you've got 2%, which is fixed for the next 3 years. Your $500,000 house should go up by 10% every year. So just make it simple. It's now worth $650,000 at the end of 3 years.
Right.
Mr. Homeowner, you've made $150,000 already. Sell the house for $650,000. buy another one using your $150,000 down that you just made,
Yeah.
and you never have to pay 6%.
Yeah. Yeah, that's the sell.
It's a great, I mean, it's a great program
Yeah.
as long as houses go up 10%
Right.
a year every single year.
Yeah, that's the thing. You can't really count on that all the time.
That means they double in
Yeah.
value every 7 years.
Yeah.
So as a young person, you look at that house, you look at a house for $500,000, which seems cheap now, and you're going, geez, it's going to cost me in 7 years $1 million for the same house.
Yeah.
I can't afford that.
Yeah.
Or the flip side is I got to buy now, even though I can't afford it.
Yeah.
So it was a mirror game that remarkably went unpunished. It was not a mirror game; it was a shell game
Right.
that went unpunished until the whole thing collapsed.
That was bound to happen.
It was bound to happen, and more of us, only a few people really kind of got it. More of us should have gone, "This is going to blow."
Yeah. Yeah, you're right. I
We
think
just didn't. I don't think we appreciate it. And I'm a commercial guy, so I've got to kind of plead ignorance. But I still knew enough to know that this is it was an unsustainable.
it seems unhealthy. Yeah.
Yeah, and what the ramifications would be once it collapsed, never even thought about until they collapsed, and then we saw the ramifications.
Come meet us over at signetinvestments.com. There you'll have access to our full podcast and articles archives. Also, if you subscribe there, you'll get new updates sent straight to your inbox. You can also find us across all social media platforms. Our handle is Signet Investing. Thank you, and invest wisely.